Hello, everyone. Welcome to another edition of the Empowering Entrepreneurs Podcast. I'm Glenn Harper.
Julie Smith.
How's it going, Ju?
I tried this new protein coffee or I don't know, whatever you want to call it, from Starbucks. I don't know that I'm a
Thumbs
fan.
up or thumbs down? No?
I don't know that I'll ever get it again.
Well, it's a shiny object. It's something new and exciting. But it is cool that it's iced, but
Shiny. Speaking of shiny objects, it's a great lead-in to our episode today.
It is. It is. We're going to talk about the elusive concept of when you're an entrepreneur, a solopreneur, how do you pay yourself? How do you get money out of your company?
And this kind of came to light because a few days at dinner, we were having a very heated discussion about what this could or could not look like. So this is the inspiration behind this episode.
Yes. So as a general rule, you have to always go backwards because, when we all start as entrepreneurs, everybody thinks because you're self-employed, you got all this money. So you're just like, well, how much do you make? Well, however much I want. I just go pull out whatever I need because I'm a multimillionaire as soon as I become a self-employed. That's what everybody thinks.
Well, I don't know if that's true.
That's not the case. So what ends up happening is you have to remember, as a general rule, if you're starting off your company, the key is, well, if you do, the general rule is that the more money you take out of your company, the less money you have for the bad times or to invest back in your company. So if you take all your profits out, you don't have any profit left, you don't have any cash left, it's really hard to run your business if you don't have cash. So you really want to make sure your business is capitalized, just have money in the bank. Now, how much? We'll get to that. But as a general rule, when you're first starting out, you have to kind of pretend like you're back in college eating ramen noodles and you can't take any money out. And you let that cash grow into your business a little bit. Because if you take it all out and then you got to loan it back, then you're borrowing money and then it gets spiraled out of control quick. Now, if your business takes off right away and we're making money, that's a different story. But most businesses, they start off a little slow, little bootstrap budget, and they're trying to figure it out. But as you let that the money grow into your account, then your next step is to kind of figure out, well, how much the minimum I need to take out of my company at home to pay my bills. Right? Most people, if they have the money in the bank account at the office, they can manage that budget of what they got to pay their bills at the office. It's when they pull the money out. You know what I'm saying with that?
Yeah. I think it also goes back to, how do you know, as whether you're a startup entrepreneur or an established entrepreneur, how do you know if you're taking the cash out of the company, or are you using payroll, or how do you start navigating those avenues?
So generally, when you first start off, you're probably going to be a sole proprietor, probably a single member LLC. And when you take money out, it's called a draw. And you probably wouldn't have payroll when you first start out because it's probably not the most tax efficient way to do that. It's when you get established and you're probably going to be making more than, say, 80 grand a year. You'll probably turn into an S corp and you'll probably take some payroll out. But most people are going to start off as self-employed. And with that, it's called a draw. And remember, you're in the highest bracket at that level, which is, again, ends up being, because you got to pay self-employment tax, you got to pay federal, state, city, everything. Generally, it's the 50% rule. So if you make $10,000, I know it's not that high. All the haters don't hate on me, but if you use this rule,
this is where we disagree.
If you use this rule forever, you will never have a problem with taxes unless you live in California. We got to bump it up a little higher. But as a general rule, if you need $100, what that means is that, again, assuming your spouse is working, probably, so you're going to be in a nominal bracket or a higher bracket. You need $100. You really need $200 because 100 of that, half of it's got to go to the tax man at some point. All the different agencies you have to pay. So if you need 100, you got to set aside 100. So as a general rule, when you're self-employed and you want to take some money out, I need $100. Take $100 out as a draw, put in your personal account. But you should also take that other $100 and put it into your tax savings account. You can keep that in the business name. That's okay.
And just to peek behind the curtain. So this is where our conversations usually go a little awry. So I'm like, okay, so I need 100 to get 200. Okay, but I'm going to write off 4,000 things. So really, I'm just at 100.
Well, that's a different concept, right? But I appreciate that. So what we have to do is,
that's how my mind works.
Correct. Well, as a business owner, again, it's about, if you're not making any money, you can't take any money out. And if you make money, the goal then is to figure out, we always say in the business, you don't want to, everybody says a write-off. It's a write-off. Kramer would say, it's a write-off. Everybody writes it off. Well, we're not saying a write-off says that you're supposed to have something that's ordinary, necessary, reasonable, and the intent is for your business. Like, I think I have to spend this to help my business grow. So a write-off just means you're still spending money. You're deducting it from your income, so you don't pay tax on it, which is what we were talking about. So if you're making plenty of money, then yes, you're going to decide, do I want to go buy a grand piano for the office to write it off. I don't need a grand piano. Maybe I should go buy a marketing campaign or something like that. So it just depends on what you want to spend your money on, and to trying to
I mean,
determine.
mentally, I need that grand piano in order to do my work.
This is true. Some people, it's very important. A new computer, whatever those things might be. So what you're trying to do is you have this operational side of what your business needs, and then you have these things that you need to take out to go pay for things personally that are your personal budget. Sometimes you can find those things that you're spending for maybe personally that really are for the business. And that's when you would you'd pay for those things out of the business so you can, quote, write them off, but they're a legitimate business expense. And there's a lot of controversy out there of what is a business expense and what's not. But as a general rule, it's the intent. Is it ordinary, necessary, and reasonable? And generally, the IRS says nothing's deductible unless they say it is. And everything's taxable unless the IRS says it isn't, which is very odd.
I mean, I think that just goes back to the reason of why you need to have a trusted advisor
Correct.
that can advise you. Clearly, I still need that advice and don't sign
Yes.
tax returns. But I think that's where it goes back to why you need that trusted advisor. But I think to summarize kind of what you said, why we kind of started this conversation is when you start out, you take draws. And as you grow and get bigger, you're going to be taking some combination of draws and payroll.
Perhaps.
You want to use the 50% rule. You want to make sure you have a budget set at home so that you're not depleting all the cash inside of your business. So as you start out as an entrepreneur, having some of those boundaries and guidelines will help set you up for success.
Did you just summarize that pretty well? That you got ChatGPT implanted in you?
Definitely do.
No, that's exactly right. And remember, once you start making more money than you need in the business, that's when you can do something cool with it. And that might be invest back in the business. It might take a big chunk out. But as a general rule, we all know at home, when you want to get paid and take your money out, whatever you take home, it goes in the vortex of doom and always gets spent, no matter how much it is. So if you can rely on a set amount every week or every 2 weeks that you're just going to take this amount and you run your household on that, then the company's bank account grows bigger. And then you can take out big chunks and do some cool things because you already set the money aside for taxes. So that, yes, you can always take your profit out. You're allowed to do it. You're going to get taxed on whether this is a good part. This is a great question we get all the time. Say your company makes $50,000 and you don't take any money out of it. How much money are you taxed on, Julie?
This is the part I hate.
It's a trick question. You're taxed on $50,000. Let's say the company the next year, the company makes no money, zero profit, but you pull out the $50,000 from the prior year. How much you taxed on? Zero. You're taxed on when you earn it, not when you take it from your company. Assuming you're a single member LLC or a sole proprietorship or even an S corp, you're not taxed on what you take. You're taxed on what you make. And that is a really hard concept for people to get because most people don't even know what they make until the next year when they close out all their books.
Which, we should do another episode. An idea is the difference on the different entity types and what's beneficial. So maybe that's a great idea for next week.
That sounds like a great one. So again, take your money out, enjoy it, but just don't take too much because if you leave your company with no cash, it's really hard to operate a company when you have no money because then you got to put the money back in, and that's never fun. There we have another edition of Empowering Entrepreneurs Podcast. I'm Glenn Harper.
Julie Smith.